Understanding the tax differences between qualified and ordinary dividends is crucial for investors to minimize their tax liability. In this guide, we will break down the key concepts and explain how these dividends are taxed. First, let's define what qualified and ordinary dividends are. Qualified dividends are dividends paid by a U.S. corporation or a qualified foreign corporation that meet certain requirements, such as being held for a minimum period of time. Ordinary dividends, on the other hand, do not meet these requirements and are taxed at a higher rate. The main difference between qualified and ordinary dividends is the tax rate. Qualified dividends are taxed at a lower rate, which is the same as the long-term capital gains tax rate. This rate is 0, 15, or 20%. Depending on the investor's tax bracket. Ordinary dividends, however, are taxed as ordinary income, which means they are subject to the investor's regular income tax rate. To illustrate the difference, let's consider an example. Suppose an investor receives a dividend of $1,000 from a U.S. corporation and is in the 24% tax bracket. If the dividend is qualified, the investor will pay 15% in taxes, which is $150. If the dividend is ordinary, the investor will pay 24% in taxes, which is $240. To qualify for the lower tax rate, the dividend must meet certain requirements. The stock must be held for at least 61 days during the 121-day period beginning 60 days before the ex-dividend date. Additionally, the corporation paying the dividend must be a U.S. corporation or a qualified foreign corporation. In conclusion, understanding the difference between qualified and ordinary dividends is essential for investors to minimize their tax liability. By meeting the requirements for qualified dividends, investors can take advantage of the lower tax rate and keep more of their investment earnings. It is always best to consult with a tax professional or financial advisor to ensure compliance with tax laws and regulations.